When you're working with high net worth clients, the goal seems pretty simple, right? Grow their wealth and make sure it's preserved for the next generation. But doing that in the most tax-efficient way possible, well, that's where the real strategy comes in. So let's dive into how it's really done.
So what's the single greatest challenge to compounding that wealth over the long haul? It's probably not market volatility. It's that relentless, quiet force that works against you every single year, the drag of taxes. It's this unseen headwind that's constantly eroding even the best investment returns.
Okay, so let's get real for a second. What's the actual cost of this? How much damage is tax drag truly doing to your clients' portfolios? Because honestly, it's often way more than people think.
And wow, when you look at the math, it's pretty sobering. This chart tells the story. A portfolio that's doing great, pulling in a 10% gross return, can get knocked all the way down to just 5.7% after taxes bite. That 4.3% isn't just a one-time hit, it's a drag that compounds year after year, representing millions in lost potential wealth over a client's lifetime.
Now, for decades, the ultra-wealthy have had this legendary playbook to deal with this exact problem. You've heard of it. Buy, borrow, die. It's simple in theory. Buy an asset that appreciates, borrow against it tax-free to live on, and then when you die, the asset gets a stepped-up basis and poof, the capital gains tax bill for your heirs just vanishes.
But here's the catch, and it's a big one. The true buy, borrow, die strategy, the kind with those super favorable customized loan terms, that's really a game for the stratosphere of wealth. We're talking 9 figures and up, so that leaves the vast majority of our high net worth clients needing a different path.
So if the classic approach is out of reach, what's the alternative? Well, there is a solution, and it takes the brilliant core ideas of buy, borrow, die, but puts them into a framework that's way more accessible, structured, and completely compliant with the tax code.
And the tools we use to build this framework are properly structured cash value life insurance policies. Specifically, we're talking about variable universal life, or VUL, and for qualified clients, something called private placement life insurance, or PPLI. And what's so elegant about this is how cleanly it mirrors that original strategy. Step 1, you buy by funding the policy, which lets your investments grow in a tax-deferred environment. Step 2, you borrow by taking tax-free loans against that cash value whenever you need liquidity. And Step 3, you die, and the death benefit passes to your heirs completely free of income tax.
This right here, this is the secret sauce. Because that tax-free death benefit, which is governed by Section 101A of the tax code, it effectively wipes the slate clean on all the capital gains that have built up inside the policy. So for the heirs, it acts just like a step-up in basis. It's an incredibly powerful and efficient way to transfer wealth.
Now, you might be thinking this sounds clever, but is it legit? Absolutely. This isn't some fly-by-night loophole. It's a strategy that is literally built on the solid foundation of the Internal Revenue Code itself. Let's peel back the curtain on the specific sections that make it all work.
Everything starts with IRC Section 772. Think of this as the rulebook. It defines what a life insurance contract is. As long as a policy is designed to stay within these guidelines, the investment growth happening inside is sheltered from the drag of annual taxes. It's the bedrock. Next up is Section 72E. This is the code that powers the borrow phase of our strategy. It's the rule that confirms that when they're structured correctly, loans from a policy are not considered taxable income. This is what gives the client that all-important tax-free access to their money.
And that brings us to the grand finale, Section 101A. This is the powerhouse that concludes the strategy. It states unequivocally that the entire death benefit, that's the original principal plus all those years of investment growth, is received by the beneficiaries 100% income tax-free. This is what makes it such a phenomenal tool for legacy planning.
So let's talk about the specific tools. For accredited investors and qualified purchasers, you've got PPLI. This is the institutional grade stuff. It allows for highly customized investment options. Think hedge funds, private equity. On the other hand, you have VUL, which is much more accessible to the broader high net worth market and uses a curated menu of investment options, kind of like a 401k. But no matter which chassis you use, the core benefits are just fantastic. You get that tax-free growth, of course, but you also get tax-free rebalancing. Imagine being able to shift between investment strategies without ever triggering a capital gain. For those using PPLI for alternative assets, it also gets rid of that K1 reporting nightmare, and both of these structures plug perfectly into advanced trust planning.
Now, it goes without saying, a strategy this powerful comes with some very important rules. This is not something you just set and forget. It absolutely requires expertise and a serious commitment to doing things by the book.
There are really 3 big guardrails to keep in mind. First, you have to watch out for MEC rules.
Fund a policy too aggressively, and it becomes a modified endowment contract, which changes the tax treatment of the loans. Second, there's the investor control doctrine. Basically, the policyholder can't be in there day trading the account. And finally, let's be realistic. The IRS is paying very close attention to these kinds of high net worth strategies.
And hey, don't just take my word for it. This quote from legal experts really says it all. This is complex planning. It demands careful, deliberate structuring and ongoing management by a team that knows what they're doing to make sure it stands up to scrutiny and actually delivers on its promise.
But when it's done right, when you navigate all of this correctly, what you've created isn't just a financial product. It becomes a true cornerstone of a family's multi-generational wealth strategy. It's all about securing that legacy.
So when you boil it all down, this strategy delivers exactly what high net worth clients are searching for. A powerful alternative to buy, borrow, die that is structured, fully compliant, and most importantly, accessible. It creates a clear, predictable path for their legacy.
Look, translating these complex tax codes into a practical, real-world solution that works for a specific client, that takes specialized knowledge. Our job is to be that resource for you, to help navigate all the details and make sure the structure is built to last.
So if you're thinking this might be a fit for some of your clients, if you'd like to explore how a VUL or PPLI could really minimize that tax drag and enhance their legacy planning, the next step is simple. Let's just have a conversation. Let's connect.